Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, October 13th, 2025. Well, the economic activity that was reported last week was sparse to begin with, but became even more so because of the continued government shutdown. So out of the two data points we had last week, one is the initial jobless claims, which we got no data on, and the last that we received, I believe, is around 229,000. So nothing to say there. The Michigan Consumer Sentiment Index did come out on Friday. That came in a little weaker than expected. Expectations were 55. It came in at 54.2. We've shown this chart before, and it's a pretty sad chart. It is down pretty much linearly since last December when it hit 75, and now it's down under 55. The only takeaway here is that, yes, consumer sentiment has continued to sag throughout the summer, early fall. However, consumer spending, fortunately, has not. In terms of employment, so the unemployment numbers, the initial jobless claims, no data for that. We'll simply reiterate the fact that labor markets are weak, no doubt about it. We are waiting for more government information as if the shutdown ever is concluded. The last data point that we got, and it's not government related, but it's the ADP employment survey, certainly showed, again, slowing economic or labor markets. We showed that in the first 5 months of the year, we had averaged, per the ADP survey, 110,000 new jobs monthly. Over the last 4 months, however, that has slowed to almost nothing, 11,000 total per month. Even with that, though, GDP growth appears solid. So you may recall first quarter was greatly impacted by tariffs, negative 0.6. It came in a very strong plus 3.8% in second quarter. Third quarter, Atlanta Federal Reserve believes we finish at 3.8%, which would be really fantastic. And again, kind of incongruent with what we've seen in the labor market with all the weakness, the unemployment claims moving up, unemployment rate moving up, and the number of new jobs created going down. Nonetheless, GDP growth appears to be solid. In terms of inflation, expectations has certainly tapped off a little bit here. So it was moving up earlier this year up to 2.45%. Now the 10-year expectation is for 2.3% average inflation. In terms of the Fed funds and the fund rate, we do have a FOMC meeting at the end of the month, the 29th, and there are now 99% probability built into the futures market that we're going to get one 25 basis point cut. And by the end of the year, end of December, the expectation is, again, same, 99%, that we'll get two cuts total, 50 basis points between now and the end of the year, but there is not a third one priced in at this point. So with that sparse economic data that was given out last week, how did the markets react? Fairly well until Friday. So market was up slightly through Thursday. And then Friday, the S&P was hit very negatively. It was down 2.7%, worst one-day return that we've had since April of this year. And what occurred was on Wednesday night, the Chinese government had announced tightening further restrictions on rare earth mineral exports. And in response on Friday, President Trump had stated he was going to greatly increase tariffs on Chinese goods and that he wasn't going to attend a meeting in South Korea with President Xi at the end of this month. So S&P 500 hit dramatically. We'll just mention that it was down 2.4% for the week. Now, Monday, as we're recording this, markets have not recovered all of it, but they are recovering significantly here Monday as we're recording. In terms of international markets, last week, the developed markets ex-US, that was also down, not quite as bad as the S&P 500. It was down 1.9%. And emerging markets also down, but not nearly as much as either developed markets ex-US or the S&P 500. Emerging markets were down 0.6%. In terms of fixed income, another good week. So the Bloomberg U.S. Aggregate Bond Index last week up 33 basis points. On a year-to-date basis, up 6.75%. So last week, the 2-year yield and 10-year yield both down. The 2-year down 6 basis points. The 10-year down 9 basis points. Now, let's take a look at the economic data that will be released this week. Again, we do have some disruption because of government shutdown, but of the numbers that we're going to get the PPI, the Producer Price Index data. That will happen on Thursday, both the core and the headline PPI number, and both are expected to be worse for the month of September than they were in August. So for the headline number, it came in at a negative 0.1 for August. The expectation is a positive 0.3% month over month for September. For the core, pretty much same thing. Core was down 10 basis points, negative 0.1 in August. It's expected to be a positive 0.2% for the month of September. Also on Thursday, retail sales ex auto, both of those are expected to be slower than what we saw in August. So the retail sales month over month was up 0.6% in August, expected to be up 0.4% month over month for September. And then you strip out autos. In August, that was up 0.7%, expected to be up again, but not nearly as much, expected to be up 0.3% for the month of September. And initial jobless claims, no data expected once the shutdown is over. And lastly, housing starts. That'll be released on Friday, won't move the market, rarely does. But that's expected actually to come in a little better than it did in August. 1.31 million. Housing starts expected to come in at 1,330,000 for the month of September. So that's it for a recap of the markets last week and a preview of this week's economic activity. Thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.